I'm clearly not Jeff Lacker. I'm Debbie Lucas. Jeff was under the weather, so he was remote today. And all our panelists are on the screen there. And given the tightness of the schedule, I'm not really going to introduce people except to say it's a very distinguished panel. I think it will continue a lot of the conversations that already started with the last two panels. I can't think of three people who bring a wider, deeper, more historical, more international perspective to these issues. So I think it's going to be a very good conversation.
Thank you very much. I think I'd like to start by saying that I think that bank supervision is a very difficult and often unrewarding task. Your successes, almost by definition, have to be obscured and not revealed, while your failures become absolutely obvious and you get shouted at by everybody. So it's a very difficult job to do. I think another sort of set of problems is that if central bank support happens to prevent or limit financial crises, then there's an argument that there's moral hazard because bankers will say that we can take risks because if things go wrong, the central bank is there to protect us. On the other hand, if the central bank does not support and the financial crisis becomes severe, then there's almost always a political reaction to say this must never happen again. And that means that regulation gets tightened even more. So that means that, one way or another, there are going to be difficulties with getting the right level of regulation. So are we then condemned to pass through what I describe as a Minsky cycle again and again, whereby regulation and supervision is tightened, often severely, in the aftermath of a crisis, and then progressively relaxed as the crisis disappears into the rearview mirror? One of the problems of regulation and supervision is that those who are regulated do not like the increase in equity that regulators frequently want. So the regulators on the one side and the banks on the other side are always in a degree of conflict. And whatever the level of equity is required, capital is required, there will always be claims by the banks and by the bank lobbies that it's unnecessary, too high, restricts growth and lending to small and medium enterprises, etc., etc. And given that they have money and power, they are likely to lead to a continuing decline in regulation until the next crisis occurs. And if that should be serious, we will then have another tightening again. So there's a kind of sort of continuing cycle. Again, the problem in some large part is that the regulators and the regulated, the bank regulators and the banks, are always in a degree of conflict. And the reason why they're in a degree of conflict is, in my view, because of another form of moral hazard, which I think is actually fundamental and particularly serious, which is that the limited liability of everybody involved, including the CEO of the banks, means that the good side, the upside is unlimited, whereas the downside is strictly limited. And that's a severe moral hazard. So inevitably, given that moral hazard, the banks will argue for and seek ever looser capital requirements. And they will try and prevent increases in the kind of equities that many of us, including Amit and Many others have argued for. And one of the things that I always want to do is to add to the issue of regulation the incentive structure of the banking system, and particularly of bank managers and controlling shareholders, and reconsider whether limited liability of everyone is actually such a good idea. Another of the problems of banking regulation and supervision is that it is very difficult to measure risk. There are various ways of doing so, but there are all, I think, of various uh, capacity. One of those is, of course, stress tests, but stress tests have their disadvantages. They're time consuming, they're only partial, they usually only involve the banks. And I'm sure we can consider more problems with stress tests. And then again, there's an attempt to use market measures. Charlie will talk about the relationship between equity values and the market value and book value of assets. And here I would tend to say one thing, which is that even to the extent that it's been a relatively successful measure in the past, if this got turned into a target for actually trying to force some change, such as a required increase in equity, then when a measure gets turned into a target, it ceases to become a good measure because it gets manipulated for all kinds of reasons, and it can be manipulated. So even the market-based measures of risk are, I think, subject to really quite considerable difficulties. Um, so I find the whole area of regulation and supervision extremely difficult. I don't think that there is any wonderful, uh, clear solution. I think that everything is problematical. Um, but just to repeat finally, the one thing that I would like to see discussed much more is not just the regulatory and supervisory system, but the incentive structure for bankers. And whether that incentive structure is actually the right structure is, I think, to me, an open question and one that is not discussed nearly often enough. But that's quite enough from me as an opening statement. So over to you both.
Thank you very much.
All right. I should go next, I assume. So let me say a few things. Very happy to be speaking to you all. It's always a pleasure. Apologies, I could not be there in person. So I'll be talking about too many rules and too much discretion, and then how do we simplify financial regulation. While I do it, I'll try to bring the current state of affairs in the banking sector as well. And it's a great honor to be sandwiched between the two Charles. So hopefully I can do justice. Okay. So, the earlier sessions obviously talked a lot about monetary policy. It affects financial stability through its impact on value of long duration assets that the banks take exposure in, or credit risk in the intermediation sector. And to start and understand what the fundamental threat to financial stability is, one needs to appreciate the fact that all banks in the system are highly levered. This is debt to assets ratio of banks, and everybody is pretty much at 90% debt. That just means always a small shock, higher interest rates in 2023 or credit risk in 2007, and you will have many institutions who are potentially seeing insolvency. And this in turn can create an important constraint on monetary policy, as we saw in the recent times, and I'll come back to it again, and also the need to keep the rates low during Great Recession. So like Charles said earlier, we have tried to regulate whenever crisis happens, and we create a bunch of complex rules, like we did in the Great Recession. And the question is, how successful are we when we do this? So the best example one can get to is what happened recently in the US banking system, so 2023. So let me give you a glimpse in case you've forgotten. It's been 2 years now. There are many other things happening. So the US banking system, starting 2022, here is a snapshot. We had about $24 trillion in the asset side, the usual cash, securities, loans, and so on. And on the liability side, 24 trillion, but 9 trillion of uninsured deposits. There is also $2 trillion of equity capital in the system, something to keep in mind. So 2023, we had seen a rise in the interest rate. So what happened? Well, as the rates rise, value of long-term assets, long-duration assets fall, and mark-to-market losses shot up slowly but surely. So we called it turbulence, and we measured it, and it turned out that the mark-to-market unrealized losses in the system were 2 trillion. Just as a reminder, this is enough to wipe off potentially the entire equity if you had to exercise these losses. But one thing to remember about these $2 trillion losses is that like 60% of them were in liquid securities. So this is not like 2007, 2008, where a lot of the losses were in illiquid assets like subprime loans. And this is something that I'll come back to in a second. How are these losses distributed? People talk about Silicon Valley Bank, but here on the x-axis is losses over assets. The vertical line is Silicon Valley banks, and this is the histogram of the 5,000 banks in the US system. And you can see that basically about 500 more banks were also facing severe turbulence. And the question was that did this all 500 banks see potential runs or would see potential runs? And we were actually looking at the liability side for a different reason that we can get to in Q&A if anybody's interested. But the aspect that we were sort of focused on was the notion of uninsured leverage in the system. And the reason now it's very clear to everyone, we were kind of trying to understand this earlier before SVB, was that these are not insured depositors. So they have quite a bit of incentive to monitor, potentially run when there is spookiness. So we used to call it flight risk. And remember, there was $9 trillion of uninsured deposits in the system. So it's not one or two banks. If you're not convinced, I can show you a histogram. So vertical line again here is SVB. On the x-axis is how much flight risk the bank has, how much uninsured deposits as a percentage of assets does the bank have. And what you can see is that, sure, SVB was an outlier when it came to uninsured deposits, but there was a lot of other banks potentially in the system where you would see pretty high uninsured deposits. So what we tried to do was to put the flight risk and turbulence together. So if you took the entire banking system and asked the question, when would you see potential risks of runs? Well, when interest rates rise, and you don't have enough cushion to absorb the losses, and you have a bunch of spooky depositors, you can get a bad equilibrium, and we called it the solvency run equilibrium, because with liquid securities, you can also still see runs, which is a bit different than the usual bank run on illiquid assets that we are used to, and all the policies are hinged on that. So how bad was it? Well, we sort of put all the banks that we thought could face these risks on the two axes. On the y-axis was turbulence, so mark-to-market unrealized losses, high and low. And on the x-axis, we put flight risk, which is how many spooky depositors do you have in your capital structure, high and low. So you can imagine on the right-hand side in the corner is bad, because that's where a lot of potential run risk is. So what I'll plot for you is a bunch of banks which were potentially facing this. Now, when you do these calculations, it's potential because you got to make assumptions on what the uninsured depositors are going to do. So this is putting in those banks where this equilibrium, bad equilibrium can emerge if enough uninsured depositors ran. Each dot is a bank which is insolvent potentially. The largest dot is the GSIP, so it's $1 trillion bank. and the small ones are much smaller banks. So not surprising, you have sort of heard this many times now. There is Silicon Valley Bank, of course, in the right corner, but there is a bunch of other banks who also were facing pretty high turbulence and high flight risk. And the question was, what was going on and what did we do post this? Now, you could ask a question which Charles posed that, where was financial regulation in all this? How did we get here? I think one has to. Sorry, I heard something. Okay. So one has to understand that too many rules were passed in 2007, like the cycle that Charles talked about. And there are two issues with it. We passed a bunch of rules and they were all focused on 2007 crisis, which was liquidity-based crisis. So, if you have one hammer in the toolkit, everything looks like a nail. And that's how we tried to diagnose all the banks that were in trouble. So from Silicon Valley Bank to First Republic to Republic First, we did a lot of liquidity infusions, but yet banks kept failing. And what we had essentially done was we had taken the lender of last resort, which is all based on liquidity, and converted everything into liquidity-based run when they were insolvent banks in the system. So in some sense, we became the lender of immediate resort, not lender of last resort. A lot of complexity in the system that we created also induces sluggishness. So if there's a lot of discretion, I'll show you that that creates forbearance incentives. One question is there a lot of discretion in regulation and supervision? I think for many of you who are familiar with this, supervision and regulation in the banks around it is done through these things called CAMELS rating. So the acronym for CAMELS is listed there. It's a rating from 1 to 5, 5 being tough, 1 being easy, as in you're doing well. And then the supervisors come up with the aggregate CAMELS composite score. So what we did was we tried to decompose the overall score to what were the supervisors doing in terms of which component was adding to the composite score. And when we do this study, what we find is about 50% of the score is projected on management score, which presumably has a lot of discretion. Now, immediately, you should not jump to the conclusion that all discretion is bad, because we show that a part of this discretion actually has information and helps in predicting bad performance of banks. So it's very useful. But a lot of it also induces noise. And turns out when you have a lot of discretion with not enough guardrails potentially, and when the responsibilities are fragmented across many regulators, you can end up with a system which has a lot of forbearance. And I'll show you one example to show you this. So a lot of banks in the US are regulated by states and federal regulators in rotation. So you can look at CAMELS rating for the same bank virtually at the same time by state versus federal regulators. And I'm going to show you this across different spells of federal and state regulators. So the vertical bars here are going to be the spells. Federal regulators looking at a bank is going to be in black, and state regulator is going to be in white. What's plotted on the y-axis is CAMELS, and on the x-axis is spells. So what this is trying to show you is that when states come in, CAMELS are lowered, which means they are laxer. When federal regulators come in and look at the same bank immediately after, on average, they tend to be tougher, so CAMELS is increased. And then when states come in, they do the forbearance again. And you find that the forbearance is much stronger when the local economy is weak. Now, that's not surprising to many of you who study political economy, but it still tells you that we have created a system where there's a lot of discretion. Discretion is useful, but it also creates potentially forbearance when you have multiple entities doing what they do. So if this was not enough to see that discretion is useful, let me again show you the same picture of insolvent banks in the system. And here is a picture which tells you how many of these insolvent banks are actually regulated in rotation. So any red dots you see is all the banks regulated in rotation. Now, it should already tell you that when banks are not rotated, it's not like they don't have problems, but a big chunk of the problems is happening whenever there is rotation. Hopefully, the visual least squares regression confirms this for you. So now what? We had a bunch of insolvent banks. What did we do? Like Charles said, there is an immense pressure to do government support, which was the right thing to do. You don't want to trigger panic. So we insured the uninsured depositors, 9 trillion. We gave a bunch of fundings to the bank and so on. But remember, there are a lot of potentially insolvent banks. And for those who remember, this reminds you of the saving and loans crisis, that you are now inducing a bunch of banks who are potentially insolvent with free money to gamble for resurrection. So how does this show up? Well, it shows up in extend and pretend, which we have seen in commercial real estate. It shows up in not uncovering fraud, even if fraud is slapping you on the face. So when you see First Brands and no one is uncovering that fraud in the US, and it's a flagrant violation of any fraud that you might think, and banks are involved, you got to ask the question that are we just in that equilibrium where people are just extending and pretending and not uncovering fraud anymore because it's not useful for them to. So how can one simplify regulation? There is too many rules and all of this discretion. So a natural laboratory is to ask, hey, how are other entities who are not banks operating in the system? And turns out we have some information about non-banks. So these are entities who also provide banking services. This is in the mortgage sector, for example. And what is plotted here is the capital structure for these non-bank entities. And turns out that they have substantially more equity, especially on the small to medium front, which is where all the insolvent banks were. If you remember, the dots were smaller in size. And what are these gaps telling you? It's telling you that a lot of small, medium banks might be just getting a lot of deposit subsidies and providing the same banking services that you could have provided even with higher equity. You can raise the equity and it can save solvency runs. It can also save other kinds of runs. And the question is, why don't we go there? One issue that we keep hearing is that if you raise higher capital, that would lead to drop in lending. That argument, while correct for bank balance sheet lending, is not correct for the aggregate credit, because two things have happened in the economy. One is banks themselves do a lot of originate to distribute, especially if they are constrained on their balance sheet. Second is that there is a lot of growth in shadow banking, non-banking, private credit, which is actually providing credit with more equity. So when you put both these things together, you got to ask in equilibrium what's going to happen to the aggregate lending. In the mortgage space, here is one counterfactual that tells you what will happen. On the x-axis is when you raise capital requirement or lower capital requirement. Of course, when you raise capital requirement on the bank balance sheet, your lending goes down, which is the usual intuition. But what actually happens for the banks per se is that the banks actually start selling loans as well. They originate and sell. So it's not that they stop lending and there is this bank balance sheet margin that's important. In addition, like I told you, there are non-banks who are also going to substitute some of this stuff. So there is a migration margin. So aggregate lending may not fall as much as you actually might think if you only focused on the blue line, which is the bank balance sheet. So what I have shown you, of course, was in the mortgage sector. You could ask, hey, is this true for the overall economy? And some of me and my collaborators sort of have been looking at this going back in time. And if you look at what's been happening to bank balance sheet lending in the background in the US, it's been falling. So where is the credit happening? It's happening in the private space, private credit space. And if you put all of that together in an equilibrium model and focused on bank capital raising experiment, like I showed you before, what do you find? Something which is not too different from what you're seeing in the mortgage market earlier. So let me conclude. The sad news is that we have a banking system where we are stuck with many insolvent banks potentially that have not been restructured. So they are zombies and we are giving them subsidies. So they might be gambling for resurrection as we speak. We have a financial stability issue which has potentially constrained monetary policy, whether we like to call it that or not. That has played a role in my view. The good news is we should have figured out by now that we can make the regulation much simpler. complex regulation is not and cannot be a substitute for higher capital. We know that we can provide all the amazing banking services with this change because a substantial part of the private market shadow banking is already doing so. So thank you.
Thank you. Okay. Charlie Calomiris, you're up.
Well, it's such an honor to be here with all of you, and especially with my two friends, Charles Goodhart and Amit Seru. And if I had more time, I would talk more about how wonderful they are. Although, of course, that's really just a preface to pointing out I'm going to disagree with them a little bit. I'm going to disagree with Charles a little bit about the potential for reform improving things. I think I'm a little less pessimistic than he is, and I'll explain why. And I may be a little less optimistic about the past than Amit, but I won't go into that. I don't think that our 2023 bailout packages, to the extent they existed, were well designed, and they didn't really even work at getting rid of liquidity risk, the things that came out of the Treasury. But I don't want to get into all of that. I want to emphasize my optimistic side about what we could do. But before I get too optimistic, let me just point out, of course, there's been a persistent failure for decades to account for bank condition accurately. It's been an intentional failure using values of book value of assets that are incorrect on purpose. Of course, we did that. We saw the massive destruction of the savings and loan industry, which was based on this, what was then called Mickey Mouse arithmetic, and we're still doing it. The two main areas where we're doing it is that we are failing to, when we have, hold to maturity accounting, we're failing to make use of market values for regulatory purposes of assets. Because remember, bank accounting is different from non-financial firms accounting in that you do mark to market the value of the tangible assets. So the first failure is we have this exception for hold to maturity, which of course really bit us in 2023. The second problem is that we don't really think about intangibles. And I'm going to point out that the failure to think about intangibles is something that we could do. That is, we could substantially improve the valuation of assets, which we've already done by taking into account market value of tangible assets, by doing the same thing with intangible assets. Okay, the two big problems, you might say, and Charles Goodhart pointed this out, why don't we do this? And the answer is, why do we make these two kinds of mistakes? And I can point out to you, because I was a regulator, I know that we do it on purpose. And we do it just as Charles pointed out, we do it because the banks don't like it. And there's a second reason, that is that Amit sort of obliquely referenced, that credit supply, politicians worry, especially around election times, whether being tough on banks will reduce credit supply. So you have two sort of political problems, which is one, bankers are often very politically powerful through their representatives and through the president, if they're big banks. And second problem is politicians don't want to have credit crunches and recessions, especially just prior to elections. And so that tends to make us not want to get serious about prudential regulation supervision. So I'll go into, though, how, in my view, these are fixable problems. Based on my experience as a regulator, I think we figured out how to make some substantial improvements, which were blocked politically, and I'll even show you some of those. But first, let me talk about some bright spots in terms of the current administration. Next slide, please. We're going to hear from my friend Mike Falkender, and of course, Mike should be congratulated. There are a lot of things that Mickey Bauman and Mike and their team at both the Fed and the Treasury have done that are really good. Eliminating the politicized abuse of so-called reputation risk in your bank examinations, which of course was abused under Operation Choke Point. And so they've gotten rid of that. focusing on risk-based capital regulation to roll back the SLR. That's another initiative that I agree with. But of course, then you have to make the risk-based capital regulation meaningful. So SLR is basically just a simple leverage ratio. And that can be overkill. But then, as I said, you need to all the more buttress the risk-based capital regulation. A general suspicion of Basel, which I share, and wanting to really sensibly Americanize the bank regulatory process. A reform of the measures requiring attention, which again is a supervisory tool that can be abused through discretion. And it has been abused in a politicized way. Again, this is cleaning up it's a good measure for cleaning up regulatory process. And the most recent initiative through the Genius Act to create a charter for stable coins. That's very progressive and forward-looking, even though I don't really like that Genius Act very much, as I'll explain later. But so I share all of these. I think these are things we should give the administration credit for. Next slide, please. But, you know, it's in the play Hamlet, it's what the prince says that really matters. And in the bank regulatory environment, what really matters the most is whether you're subsidizing risks, as both of my prior colleagues on this panel have pointed out, we are. The two big things that the administration is pushing for right now are clear expansions of the subsidization of risk. One is the GSE privatization with no credible risk discipline will lead to a repeat of Fannie and Freddie's contribution to the crisis of 2007, 2009. The administration doesn't seem to be very concerned about that. Again, I think that's because of strong political incentives with the upcoming election. Second place we see that is the Treasury pushing, and some of the Republicans in Congress are trying to resist, for the expansion of deposit insurance. This is being justified by saying, well, too big to fail is creating unfairness. It's disadvantaging the small banks. And of course, we saw that during the 2023 crisis. But of course, two wrongs don't make a right. And what we know from financial literature, almost a unanimous, unusually unanimous perspective is that expanding the coverage of deposit insurance, making it more generous, predictably increases systemic risk. So this is a horribly myopic idea. It's probably going to win support because it's bipartisan, because of course Elizabeth Warren loves bad ideas as much as Donald Trump does. So here you are. We've got, you know, a wonderful alliance. I think the Genius Act, for all its good intentions, ended up codifying a not great business model, especially by requiring demandability of stablecoins. But I'm not going to get into that. So I think next slide, please. And of course, the main failures are adding these risk subsidies and then at the same time not fixing the existing risk subsidies. So the Trump administration has continued the Biden administration's failure to deal with the weak banks that were flagged as weak in the 2023 crisis. And it's wonderful to follow Amit Seru in this panel, because then I don't have to explain. He explained his group that estimated 600 banks that are tottering on the brink of insolvency that nobody seems in Washington to worry about. And I would say we're especially worried about this because commercial real estate hasn't recovered from the COVID crisis. Some areas of office buildings aren't recovering very much. And some estimates say that as much as 20% of office buildings with maturing debts this year will end up having maturing debt in excess of the value of the principal. That's an ingredient for a commercial real estate crisis. I think more generally, we've failed to fix the big bank problems that have to do with too big to fail by requiring those banks to have real capital. Again, remember the two errors are allowing banks to fake their capital with hold to maturity accounting, but then also failing to account for intangible assets and how that can cause big increases or reductions from what you get from our current capital standards. Next slide, please. And what I really want to emphasize here is that the thinking in the academic literature on banking has really evolved on how important the market values of banks' assets are in understanding where crises come from. And as again, Amit said, solvency runs. So there's been a long train of new studies. I'll talk very briefly about them, and some of them directly linked to crises. So my paper on the Chicago crisis of June 1932 showed that the banks that were known in the market to be weaker were the ones that failed during the Chicago banking crisis of June 1932. They also paid higher interest rates on their debt in advance of the crisis. So this shows that markets really are very aware, and that market prices reflect correct perceptions of bank problems. I also showed similar results for measurements of risk in the equity market, as well as value, in understanding which banks experienced bigger problems in New York during the Great Depression, and showed that basically the market disciplined the banks and forced them to target implicitly low default risk on their deposits. None of the New York banks failed. None of the big New York banks, or even the top 30 New York banks, failed during the Great Depression. The reason was the market forced them to be worried enough to target their default risk. And deposit insurance didn't apply effectively to any of those banks because their deposits were so large that they weren't really covered by the FDIC effectively very much during the 1930s. So it's a great example of how discipline can work when banks aren't excessively protected. Then Dick Herring and I have a 2012 paper, and I'll show you some slides from that shows that the 2008-2009 crisis, both in the US and in Europe, was quite forecastable. That is, which banks would experience problems was quite forecastable if you were following the market value of their equity ratio relative to assets, as opposed to the false and distorted book values. And in fact, what we show is that when crises happen for individual banks, it was because they hit a critically low level of the true equity ratio relative to assets, which basically made it impossible for them to roll over uninsured debts. And that's when they entered crisis. The problem, of course, though, was people think that that's some sort of a contagion, but it really wasn't, at least not until September and beyond, because a lot of the banks just didn't have that problem, as I'll show you. And many of them, as you may remember, Wells Fargo in particular, asked the government not to force them to accept government assistance, but they were forced by Secretary Paulson to do so because he believed somehow that would lead to, that would mean that the market wouldn't be able to tell who was weak and who was strong, which is, a nonsense. Next slide, please. Clearly Bank of America and Citi were the ones who were of the biggest ones, the weakest. When they hit this 2% threshold, they were put into a crisis, but other banks weren't in a similar circumstance. Next slide, please. Here you can see a graph of a backward-looking 90-day moving average of the market equity to asset ratio. And you can see off to the left, you'll see that Citibank, which is a gray kind of hashed line, is at about 13% in April of 2006, its equity to capital ratio. And you can see that line falling and falling over a long period of time. There's nothing sudden about it. The losses for many of these banks that were very weak didn't occur suddenly. They occurred gradually. The market was very aware of them. And then finally, when each of these banks, you'll see first in the case of Bear Stearns, when it gets to this 2%, that's when basically the market says the jig's up. That happened for Citi as well. So the point here is, if supervisors had been paying attention to this and reacting to it, and if banks had been forced to recapitalize as their equity values were declining, we wouldn't have had a crisis. Next slide, please. So you saw some of the banks in the prior slide and all the banks in this slide never got to that 2% threshold. So in some sense, although in September of 2008, it did become a systemic crisis, the point is if the individual banks that were in trouble had been forced to maintain themselves in their capital ratios, these other banks were doing fine. They would never have had any problem. It was really just a few banks that were allowed to be undisciplined that caused the problem. Next slide. I want to show that we now what's this importance of intangibles, because that decline in the market value ratio reflected two different kinds of declines. One, an unrecognized decline in tangible assets, that is, bad loans that weren't being booked as bad. And secondly, declines in income relative to expenses on intangibles. So banks run businesses that don't have tangible assets, but it's all about the cash flows and the present value of the cash flows that contribute as assets. But if the banks aren't running their businesses very well, they actually have negative intangible assets. So if you look now, this is a 2017. This is, almost a decade after the crisis. You can see that the two banks that were in trouble, they really created the problem for the banking system, Bank of America and Citigroup. Now we're in 2017, and they're the two of the three banks on this list that are showing negative intangible assets. That's what being less than one means. It means that the value of your assets is less than the value of your tangible assets, which is what your book value is roughly. So we haven't fixed the problem, and we're really subsidizing these banks when we do things like regulate book values or even stress tests, which are themselves also done in book values. What we're doing is subsidizing these bad banks and taxing, in some sense, the ones that have high intangible assets and the like U.S. Bank Corp or TD or M&T or Wells Fargo or JP Morgan. Next slide, please. I also want to give credit to the NYU Stern School's website for the SRIS model, which allows you to see which banks would survive based on a market evaluation of the bank's positions, which banks would survive a major crisis and which wouldn't. I won't talk more about that, just to call them out as a great contributor to this literature. Next slide. Now, Daron Nissim, who was my colleague at Columbia, and I, back in 2014, did a paper where we tried to show that you could, in fact, measure cross-sectional differences in bank intangibles very well and predict them very well based on the cash flows of banks, where they were generating their profits. And I'll come back to the regulatory uses of this in a minute. And I'll also point to Matt Barron's article in the 2021 QJE showing that equity declines of banks were the essential thing that predicted credit contractions historically prior to the one we just experienced. So my point is the academic literature is clear. Next slide, please. And I want to show you that there's a lot of variation. So this is from my paper with Daron Nissim in this market to book value ratio. Here we're just showing you the four quartiles. And you can see there's just enormous variation. And that's true before and after the crisis. And a lot of banks are underwater in terms of having negative intangible assets, running bad businesses that are tolerated because of this phony accounting that we do in our regulatory process. Next slide, please. So I'm finally coming to the end. What can regulators do? And so at the OCC, we said, well, here's a list of all the things that we knew we could do. We could add just this ratio that has proved so helpful. And we could add it as a key indicator for what's called the NRC Early Warning Suite, which is a kind of set of indicators that you look at. It's not a hard regulation, it's just a set of indicators. And when you get to a point of concern, you use your supervisory discretion to tell the banks to recapitalize. But it's not pure discretion because it's based on an observable. You can also employ it in setting the countercyclical capital buffer. You can employ it for a lot of other purposes. And of course, Charles Goodhart mentioned, of course, you could also make it a hard rule in a regulatory framework. But what I want to show is that when we talked about doing that at the OCC, we didn't talk about just taking the market value of equity from the market. That we talked about several different approaches that would be used simultaneously that could be incorporated into all of these tools I'm listing here. And so I don't think it's so open to manipulation, partly because of this multiplicity of measures and multiplicity of tools. Next slide, please. So we've talked about, there are lots of proposals I've talked about before. I won't go into these today, of ways to make the regulatory process incorporate economic understandings of assets and capital. Next slide, please. And I just wanted to show you, here are some slides that we developed. So I had a Manhattan project at the OCC with about 30 PhD economists where we said, how could we do this? And I'll just show you some of the slides very briefly. Next slide, please. So this is a slide sort of pointing out there are different ways to get economic value of assets that incorporates all these things. And each of these concepts is going to have very broad kind of application within the banking system. Next slide, please. And we can think about trying to specifically target default risk of the bank's liabilities as the way to create risk-based capital. And we can do this in all of these different concepts, these three concepts, and each of them has a different empirical methodology, which is well known in the financial economics literature. Some of these are regression-based, some of these are cash flow estimation-based, some of them use market values or market volatilities. And the point is, there's not just one, but multiple approaches. Next slide, please. And so this is a slide that I presented to the comptroller. Here's how we can do this. We can use these different frameworks. We showed that this was actually very useful for a lot of banks. There is no good reason not to do this. Incorporate it both as a supervisory dashboard tool and as a regulatory standard. Next slide. That's pretty much the end. And my slide is basically, okay, we keep having these politicized failures. Then politicians do bailouts, wring their hands, blame the market. And I don't think this is the best we can do. Thanks for your attention.
Thank you. Okay, we just have a few minutes for questions, and I will not take any prerogative to give the audience a chance to ask their question. Yes.
Given the current capital structure of the banks and high valuation of financial assets, raising equity capital likely would impact negatively equity prices and potentially and ultimately impact aggregate demand for loans for lending through reverse wealth effects or perhaps income. My question is, how can an aggregate model, equilibrium model for aggregate lending incorporate this dynamic, if it already does, and how can it incorporate this potential dynamic? Thanks.
Thank you. Let me take a few questions if there are more questions, and let's keep them brief, please, because we only have about 3 minutes. I think there's a question over here.
Hi, this is James Robertson from Grant's Interest Rate Observer, and my question is about Mr. Goodhart mentioned the inherent moral hazard in limited liabilities of banks. I mean, from the Civil War to the 1930s, we had a double liability where shareholders in American banks were responsible not only for their investments, but a portion of the bank's debts after insolvency, and it aligned shareholder and depositors' interest. I mean, and I wanted to ask the panel whether they would agree with a return to a double liability system.
Okay, so why don't we take those two questions? I guess, Amit, the first one was maybe for you.
Okay, so, there is a question about doing a full-blown general equilibrium kind of a model that you have in mind, which of course we did not do, and one can do it. But my point is much, much simpler. My point is you have a bunch of zombie banks potentially. And for 2 years, we have had the opportunity to either restructure them or combine them, because raising equity, remember, raising equity is expensive, and we should worry about it as social planners if there is a valuable service and there is illiquidity in the system, which is not insolvency. When we think something is insolvent, we should be restructuring it, not throwing good money after bad, which is what's been going on. So that's a separate point. To your general equilibrium point well taken. I think one can do a full-blown analysis with all solvent banks and then shocking them and then seeing what happens with wealth effects and so on. So I wouldn't advocate go tomorrow and raise equity for all the 4,000 banks because many of them are bad and many of them might be illiquid but solvent. So we want to separate that out. For 2 years, we have been just kicking the can down the road. That's not a good way to go about it. I will let Charles speak about the deposit double liability, but because you posed it to everyone, I have my reservation on what will do to the talent pool that might enter, but maybe Charles can answer that.
The talent pool would remain just the same. I remember we had unlimited liability, more or less everywhere, until in the UK, the City of Glasgow Bank in the 1880s. And there was absolutely no shortage of qualified people prepared to come. This talent pool argument, I think, is vastly overblown. The reason for the ending of the reserve requirement, though Charlie would know much more about the American history than I do, is that there were a huge number of very small shareholders, and it was very difficult to track them down. It was costly, and it became politically unpopular. The argument that I'm making is not that you want to get rid of limited liability for the ordinary outside shareholder. It's only those who have power and inside information where limited liability could be reconsidered. And if I can just have a quick word about Charlie Calomiris. Charlie's arguments about taking more into account market measures is absolutely entirely correct. But, and there is a but, if you're going to tell as a bank supervisor, a big bank, that it has got to increase its capital, you're going to have some fairly solid reason for doing so. That means if there's got to be some solid reason for doing so, you've actually got, I think, to formalize the ratio that you require to require recapitalization. And once you actually start formalizing this ratio, you get into the problems of manipulation that worry me.
Very good.
And I don't disagree with Goodhart's law, but I do, especially when Goodhart's on the panel. But I do think that by having many different ways of measuring it, using cash flows, using regression analysis, and using market values of things, both volatilities and prices, you reduce that substantially, Charles.
And can you imagine a bank supervisor going to a politically important CEO of a major bank and saying, my regression, this ratio, that other thing, and a whole series of things? And think about how a bank supervisor actually tells a bank manager that he's got to raise extra equity. It's not easy.
So I just will say that I think it's actually easier than you do, because I think that the chief risk officer of the bank in particular, is somebody who speaks exactly the same language. And so I think the banks are actually more sophisticated than the supervisors. So one of the things we have to do is improve the supervisors' quality of training. But also let me also agree with you that bank compensation needs to be reformed. And one of the ideas that came out of the finance literature that rhymes with your double liability idea is to force compensation to take into account the value of uninsured debt. So, for example, my former colleague Patrick Bolton had a very nice paper sort of showing that if you don't just have everything be equity and option on equity compensation, you make the compensation sort of mimic a little bit of what you're talking about. So I think I agree with you. I think there's a lot of room for that reform.
You know, I heard we had an extra minute, and I'm going to grab back the podium to ask a question. You know, I was listening to this and thinking there wasn't much about the conversation that couldn't have happened or couldn't have been discussed quite a few years ago. But what is so salient right now is the re-rise of shadow banking and the movement of financial intermediation out of the banking system. And so I'm curious, it's a question for all of you, how the views that you expressed are different or shaped or somehow, this whole issue of, you should raise capital, but what if everyone else doesn't have to, does it even move more intermediation out of the regulated system? So maybe people could quickly comment on that.
I could go first unless Charles, you want to go first. So I actually think calling it shadow banking, as you know, comes from the name comes from banks calling this nefarious sector out there. I think we should collect a little bit of information, and then it's competition, and you let the competition run. They have shown you that they are bringing in equity capital. They are taking risks. There is skin in the game. Yes, there are bad players. You take risks. Some pan out, some don't, but they absorb the losses. The question for me is, we have a banking system with so much regulation, so much supervision. How did First Brand do all kinds of fraud when we had two salient publicly traded banks giving them money for the last 2 years when fraud is happening right under their nose? So I'm not that worried. I'm more worried that we are so fixated that we are doing an amazing job with the banking system that we are now going to also take the shadow banks and reduce the competition. We should let the markets figure this out.
I mean, you're being totally inconsistent. You're arguing for higher equity capital ratios, which is exactly what is going to drive things into the NBFI.
No, it's not, Charles, because the other sector also has a lot of equity. I am asking more skin in the game in both sectors.
If I can just interject finally. So, Debbie, what's really interesting is when I was at the OCC, the reason why we got a lot of support for trying to bring market analyses of cash flows, of prices, of volatilities, using regressions, all of these things, was that we had to answer the question, how do we modernize the bank charter to apply prudential standards to new kinds of financial intermediaries that we were trying to charter at the OCC? And because a lot of them didn't have a lot of book value of assets, the Basel system was just a non-starter. And so I think that was the fact that there was a lot going on in fintech that was different from traditional banking really helped make the arguments we were making resonate, because standard book value accounting was clearly useless for a bank that had very thin balance sheets and a lot of cash flows.
Great. Well, thank you. Thanks to everyone. Okay.
Thank you.
And everyone will be very happy to know, I think we're adjourned to lunch. Yes.